Welcome to CRE Fast 5. I'm Carly Iacono, and tonight we are reviewing the basics of letters of intent. If you are a new investor writing your first letter of intent or LOI, this can be a very daunting process. Tonight, I'll walk you through the sections of an LOI and help you understand what should and should not be included. Note that LOIs are used in both leasing and investment sales transactions, but tonight's episode relates strictly to language and acquisitions. Now, as you know, I cannot give you legal advice, so make sure your deal team also includes a qualified commercial real estate attorney. Here we go. An LOI is designed to be a non-binding outline of terms that you as the buyer would be comfortable proceeding under. If written clearly, LOIs are a much more efficient way to negotiate deal terms than going straight to a purchase and sale agreement or PSA. And this is how most commercial transactions begin. In my experience, the best LOI templates are no more than 2 pages long. You want enough information to clearly outline the deal structure, but not so much that the main points get lost. I'm going to run through each of the sections of the LOI for your benefit, but as always, feel free to reach out to me directly to walk through your first offer. First and most obvious is that you need to list the property with a clear address. If there are multiple properties as part of the same offer, they should all be listed out individually. If you're purchasing a property with multiple contiguous parcels, adding parcel numbers is helpful. Above all, you want it to be clear exactly what it is you're offering on. Next is your offer price. If the investment is a sale leaseback, meaning the current owners will be selling the real estate and signing a long-term lease as the tenant, there may be some variability for the net operating income or NOI. So it's important to not only note your offer price, but also the NOI on which that price is based. Listing the cap rate of your offer is optional, but can make it more efficient for the seller and deal team to review. The next section is the earnest money deposit. This is typically payable a day or two after the contract is signed and is often refundable during the contingency periods. For the earnest money section, you need to note who will be holding the earnest money deposit, typically a title company, and under what conditions it is refundable, if any. Often, but not always, a second earnest money deposit will be offered at the conclusion of due diligence. How much the deposit is, when it is to be delivered, and under what conditions it is refundable are all items that need to be addressed in the earnest money section, along with who is going to choose the title company if they will be the ones holding the deposit. The next section is the due diligence period. This is the time period that you have to review the documents provided and get updated third-party reports such as surveys, title, and environmental. 30 calendar days is the most common for standard net lease deals, but that may be longer or shorter depending on your individual investment. Make sure you are always noting whether your offer terms are calendar or business days, as this is a very big difference in the timeline and has led to more than one disagreement that I have seen. Moving on to the financing contingency period, this is the section under which you request a certain amount of time for a mortgage contingency and note when that time period is to start. For example, if your financing contingency coterminous with due diligence, or does it start before or after the due diligence period? If your offer is not contingent on financing, that does not mean you cannot get a mortgage, but rather that you are waiving your rights to a mortgage contingency period in the contract. Some sellers will request more details in this section, such as expected loan to value, interest rate that you're seeking, etc. But I found more often than not that it is left to the buyer's discretion within the time frame, being the only thing outlined as whether there is or is not a mortgage contingency. The next section will be your closing timeline. This will vary depending on whether or not you are obtaining financing. Typically, your closing date is stated as a certain number of days after removal of all contingencies. 15 or 21 days is fairly standard, but again, this can be case by case. The next thing you need to address are the closing costs. Customary closing costs, as in who pays what, varies by state. You can keep your LOI simple by saying buyer and seller to split closing costs as per local custom. However, you should first be aware who is expected to pay for the title policy, escrow fees, transfer tax, documentary, stamp tax, etc. in your state, so you don't have any surprises down the line. The buyer typically pays for their own due diligence costs, such as updated surveys and phase 1 environmental reports, and both parties typically pay their own legal fees. If you are looking for more of the closing costs to be shifted to one party or another in a way that is not typical in that state, you should consider writing more detailed language in the closing costs section so everyone's on the same page from the beginning. Now let's move to the contract section. This is where you outline who is preparing the purchase and sale agreement or PSA and what the expectation for the time frame of the first PSA draft and completed document will be. These timeframes are hard to enforce, but they do set the stage for both parties. Typically, the seller's counsel prepares the first draft of the PSA, so should you as the buyer prefer to have your own counsel do the first draft, this should also be addressed upfront in the LOI. Next, there will be a brokerage section that clarifies which firms are representing the buyer and the seller and who is responsible for brokerage fees. After the brokerage section, you may or may not see an exclusivity paragraph. Buyers will often try to insert exclusivity language that gives them some level of protection that they have the deal while the contract is being negotiated. Sellers often push back on this language for obvious reason, but it is something to consider either way. The last section typically addresses confidentiality, stating that both parties will keep the offer terms in strict confidence. Finally, you'll see an offer expiration date and additional language stating that the offer is not intended to be a binding contract. Letters of intent are also referred to as deal term sheets because they are meant to be a high-level outline of the terms that the purchase and sale agreement will later memorialize. They are not binding, so if you are the buyer and do not have exclusivity language, you will want to get the PSA signed as efficiently as possible so you retain control of the deal. Now, although LOIs are not binding, they are an agreement between parties, and materially changing the agreed upon terms down the line is not usually looked upon too favorably by the other party. So be sure you are comfortable with the offer terms and understand each section thoroughly before you move forward. As always, I'm here to help you navigate your acquisitions or dispositions with ease. Use the Calendly link below to schedule your one-on-one investment strategy call. That was CRE Fast 5. I'm Carly Iacono. I'll see you next week.